This is part 2 of market structure, the advanced version. In this video we will dive deeper into market structure and analyze the details hidden within the structure to identify potential shifts in bias and breakouts. Let's look at gold. Gold has reached an all-time high recently and is fundamentally very bullish. We want to get in on the action and buy during the correction. But how do we know which point during the correction is the one where price will reverse from? We have liquidity sitting below these higher lows, these higher lows, these higher lows, and these higher lows, and our lowest demand zone right here. Price can break below any of these before it reverses. There's just no way for us to know where it will reverse from. That's where our understanding of market structure comes in. We just let the price go where it wants to go. Once we see a shift in structure, that's where we start looking for an opportunity to enter the market. We can see this is where the price reversed from, so let's zoom in. This is what I see. Price is melting down, consolidating for a little bit, and continues down but at a much slower pace than previously. This doesn't necessarily mean anything, but it shows signs of exhaustion. And right after this low we have a long period of consolidation and price slowly building up again. An order block gets liquidated and so does the previous high. It's so small you can't even see it, but trust me, it's there. Don't worry if you don't understand. Sweeps and order blocks and everything else I talk about will have their own video later on in the course. Following this ideology, in some cases it would be okay if you enter long within these lows. Even if you did and you got stopped out for -1% loss, it's fine as you'll make it back plus more later. But ideally we want to see both sides of the market be swept, then change character. Just like in this example. And just like it happened here, we also broke this little point of structure here, which gives us more confluence. In a perfect world we'd want to enter at this fresh 15-minute demand zone, but as you see it doesn't happen here. It would also be okay if you entered at the discount at the bottom of this structure point with a bigger stop loss. Which would give you a 1 to 11 risk to reward trade. But you can go a step further, or if you miss this initial trade, you already have your reversal confirmation here. This rejection is another indication that price is ready for a push higher. All you have to do now is enter long on a pullback. I'm sure if you went down to a 5-minute or 1-minute time frame you would find a perfect sniper entry. But this is a topic we discuss in my sniper course. Even without the perfect sniper entry, if you entered within this area and a stop loss below the low, you would end up with a floating 1 to 31 risk to reward trade. Which is just insane. Let's look at another example. After the huge impulse move to the upside, price consolidates and builds up liquidity which has to be taken out at some point. We also have an order block sitting right below the liquidity. I don't usually enter trades at order blocks because I expect them to be taken out. Order blocks are also pools of liquidity, that's why most of the time they are liquidated. However, if you get a confirmation that an order block is being respected, it's okay to look for trades. This little W pattern is what we're looking for. It looks like an M pattern if we're looking to short the market. But in this case it's a W. Ideally after the second low of the W you want the impulse move to change character or break some point of structure on the lower time frame for extra confirmation. The markets always do what they want, so if it doesn't happen it's fine. And just like before, ideally you would want to enter at the freshly created demand zone. Which again doesn't happen here. So let's just stick with the safe entry at a discount near the low of this structure. Which gives a 1 to 11 risk to rewards trade at its highest point.